Hey, my name is Colder. I hope you all are well. Today we are going to talk about inflation. Yes, inflation. Inflation is everywhere, yet almost nobody truly understands it. Most people believe inflation simply means rising prices. Groceries cost more. Fuel becomes expensive. Rent increases. But that explanation only describes the surface. Inflation is not just about higher prices. Inflation is about movement inside the financial system. It is about who receives money first and who receives it last. And that timing quietly changes everything. When new money enters the economy, it does not appear in every bank account at once. It moves through financial institutions first. It flows into banks, lending markets, corporations, and government programs. It does not immediately flow into wages. This delay creates an advantage. Those who receive money early spend it before prices rise. They invest in assets while prices are still lower. By the time wages adjust, the cost of living has already increased. This timing gap is rarely discussed publicly, but it matters more than most people realize. When liquidity enters markets, asset prices respond quickly. Stock markets often rise during inflationary periods. Real estate values tend to increase. Commodities such as gold and oil often surge. But assets are not evenly owned across society. A large portion of stocks and property is held by a smaller percentage of people. So when asset prices rise, wealth concentrates further. Meanwhile, cash savings lose purchasing power. A bank account earning minimal interest cannot keep pace with rising prices. Over time, this creates a silent wealth shift. From cash holders to asset holders. From savers to leveraged investors. This shift happens quietly and gradually. There is no headline announcing it. It unfolds through numbers and percentages. Debt behaves differently during inflation. When prices rise, the real value of fixed debt declines. Borrowers repay loans with money that is worth less than before. Governments carry enormous amounts of debt. Large corporations operate with structured borrowing. Moderate inflation can reduce the real burden of those obligations. Without raising taxes directly, debt becomes easier to manage. For households, the impact depends on position. Homeowners with fixed-rate mortgages may benefit slightly. Property values can rise while monthly payments stay constant. But renters face a different outcome. Rent often adjusts upward quickly. Without asset ownership, there is no appreciation benefit. Wages usually adjust slowly. Employment contracts and negotiations take time. Corporate budgets are not updated overnight, but prices can change within weeks. Even a short delay reduces purchasing power. Inflation also changes behavior. When people expect prices to rise, they buy sooner. Businesses anticipate higher costs and raise prices early. Investors move capital into inflation-protected assets. Expectations fuel momentum. Inflation becomes psychological as well as monetary. Modern economies operate on credit expansion. Banks create loans that expand money supply. Central banks influence liquidity through interest rates. During crises, liquidity injections stabilize markets. These injections often support asset prices first. Financial markets recover before wages do. This pattern has repeated across cycles. Liquidity enters. Assets rise. Wages lag. Over time, repeated cycles widen gaps. Not suddenly, but cumulatively. Inflation also affects businesses differently. Large corporations with pricing power can pass costs to consumers. Smaller businesses struggle to absorb rising expenses. Some close. Market share consolidates. Inflation can accelerate concentration within industries. Currency perception changes during inflation. Capital seeks alternative stores of value. Investors move into real assets and commodities. Exchange rates adjust in response. Emerging economies often feel amplified effects. Import costs rise when currency weakens. Global systems are interconnected. Inflation in one major economy can ripple worldwide. Media narratives often simplify the story. They focus on supply shortages or corporate decisions. But monetary policy and liquidity matter deeply. Over decades, persistent inflation reshapes society. Those holding appreciating assets maintain purchasing power. Those relying solely on wages struggle to keep pace. Even small annual inflation compounds significantly over time. 10 years can transform cost structures entirely. Retirement planning becomes more complex. Savings must generate higher returns to remain stable. Pension systems must adjust for rising liabilities. Inflation is not always destructive. Stable, moderate inflation can encourage investment. It discourages idle hoarding of cash. But misalignment creates pressure. When living costs rise faster than income, tension grows. Trust weakens when explanations feel incomplete. The hidden side of inflation is structural. It is embedded in timing and ownership. It is shaped by incentives and access. Understanding inflation requires looking beyond prices. It requires examining flows of money. Where does new money enter first? Who benefits from early access? Who holds appreciating assets? Who carries fixed debt? Who can raise prices quickly? Who waits for wage adjustments? These questions reveal a deeper picture. Inflation is experienced differently depending on position. The grocery bill is only the visible signal. Beneath it lies a network reallocating purchasing power. Once understood, the economic landscape appears different. Inflation explains expanding portfolios during turbulent times. It clarifies why saving strategies must evolve. It highlights the importance of financial literacy. Inflation is likely to remain a feature of modern economies. Credit expansion and fiscal policy are embedded in growth models. The difference lies in awareness and positioning. Those who understand